Hey guys, welcome to my channel. If you enjoy watching and want to see more, don't forget to subscribe. I share videos that are helpful and easy to understand.
The Federal Reserve often buys bonds. This action is a key tool. It is called quantitative easing, or QE. The Fed buys government bonds. It also buys mortgage-backed securities. These purchases are made from commercial banks. When the Fed buys bonds, it pays the banks. It credits their reserve accounts. This increases the bank's reserves. Banks now have more money. They have more funds available to lend. This is the first major effect. Increased bank reserves have several consequences. Banks have excess liquidity. They want to put this money to work. They will often lend it out. This boosts the overall money supply. It makes credit more available. It also impacts interest rates. When the Fed buys bonds, it creates demand. This increased demand pushes bond prices up. Higher bond prices mean lower bond yields. Bond yields are essentially interest rates. So, borrowing costs across the economy fall. Mortgages become cheaper. Car loans become more affordable. Business loans also see lower rates. Lower interest rates stimulate economic activity. Businesses find it cheaper to borrow. They can invest in new equipment. They can expand their operations. This creates jobs. Consumers also benefit. They can borrow more affordably. They might buy new homes. They might purchase new cars. This increased spending boosts demand. It drives economic growth. The goal is to stimulate a sluggish economy. It helps avoid recessions. It can also help during recovery periods. However, there are other effects. A larger money supply can lead to inflation. If too much money chases too few goods, prices rise. The Fed monitors this closely. They try to balance growth with price stability. Lower interest rates can also affect the stock market. Stocks become more attractive than bonds. Investors seek higher returns. This can push stock prices higher. It can create a wealth effect. People feel richer and spend more. The Fed's bond purchases also impact the dollar. Lower interest rates can make the dollar less attractive. Foreign investors might seek higher yields elsewhere. This can weaken the dollar's value. A weaker dollar makes US exports cheaper. This can boost export industries. It also makes imports more expensive. There are potential downsides too. Prolonged low rates can create asset bubbles. This means prices for assets like stocks or real estate become inflated. This can lead to instability if bubbles burst. The Fed uses bond buying strategically. It is a powerful monetary policy tool. It aims to achieve maximum employment. It also targets stable prices. These actions are complex. They have wide-ranging effects. They influence everyone's financial life. Understanding these actions is important. Thank you for watching. Please like this video and subscribe to our channel for more economic insights.
Thanks for hanging out with us today. If you enjoyed the video, tap that like button, subscribe to the channel, and ring the bell so you don't miss what's next.